Introducing yourself and your affiliation. Keep your eye on the timekeeper. Yellow light means you have 1 minute left, and then obviously when the red goes on, your time is up. Each panelist has 5 minutes, and we'll start with Jim, whenever you're ready.
Good morning. Thank you. My name is Jim Carr. I'm the Chief Business Officer for the National Community Reinvestment Coalition. NCRC and our more than 600 member community organizations are committed to ensuring fair and equal access to credit, capital, and banking services for all Americans. On behalf of our CEO, John Taylor, our members, and the millions of people we serve, I thank the Federal Reserve for granting NCRC's request to hold public meetings. How you decide Capital One's bid to buy ING Direct will be precedent-setting. I start my testimony today by sharing a quote from Alice in Wonderland. If I had a world of my own, nothing would be what it is, because everything would be what it isn't. Like the Mad Hatter, Capital One lives in a world of its own. The bank believes that somehow becoming the 5th largest bank in the United States will decrease rather than increase systemic risk. Such an implausible proposition from Capital One indicates that the bank either, 1, is out of touch with the risks and complexities of the business it's involved in, or 2, truly does not understand systemic risk, or 3, is simply not taking the Federal Reserve's hearings and the American public's concerns seriously. The risks and dangers of Capital One's business model are patently evident and easily understandable. First, Capital One's monoline credit card business model is flawed, unsafe, and unsustainable for growth. Both from its previous bank acquisitions and its current plans to buy HSBC's credit card business, the public has every reason to expect that Capital One will continue to bet on a high-risk credit card strategy. Like the predatory and toxic subprime mortgages that eventually imploded the financial market, taking the entire financial system with it, Capital One's credit card business is poised to become the next subprime crisis in America. Its business model is particularly susceptible to economic downturns, and just last week, Federal Reserve Chairman Ben Bernanke revised the Fed's outlook for the economy, stating there are significant downside risks. Second, by saying yes to this deal, the Federal Reserve will likely enable Capital One to account for more than 32% of all outstanding credit card securities in the ABS market. That's $1 out of every $3 in a market that many agree will be the trigger for the next financial catastrophe. In addition, 1/3 of Capital One's credit card debt is subprime, and more than 76% is securitized. When those facts are added to the reality that Capital One is also the largest issuer of subprime auto loans, the dangerous and toxic nature of its business is clear. Third, the mere act of becoming the 5th largest bank will by itself allow Capital One to increase risk. It is unreasonable to suggest that the failure of the 5th largest bank would not have substantial negative consequences, both real and perceptual, for the broader financial system. Moreover, for a large part of what fuels systemic risk is the ability of a financial firm to grow using high-risk business strategies that would not be possible absent the perception that the firm is too big to fail and therefore will be bailed out if it gets in trouble. Let me ask you this. Does it make sense to approve an acquisition that will create the 5th largest too-big-to-fail bank prior to putting into place appropriate regulations on what creates systemic risk, how to properly manage it, and how to wind down institutions when they get into trouble? Capital One's forward commitment is just as unrealistic as the notion that its purchase will decrease systemic risk. As Alice says, there's no use trying. One cannot believe in impossible things. The suggestion that $180 billion over 10 years could possibly offset the financial costs associated with its potential failure and the impact to the financial system is as make-believe as Wonderland itself. The cost of the last financial crisis did not stop at the expenses of TARP. The real cost was over $7 trillion of lost wealth by the American public, 10.5 million foreclosures, more than 7 million jobs lost, and the lingering pain of 9.1% unemployment which exists today. Indeed, the American taxpayers are still paying for the last financial crisis, which included bailout funds to Capital One. The American public cannot afford to pay for another bailout when, not if, Capital One fails. In closing, making a monoline business right with subprime and securitized credit card assets, the 5th largest bank in the United States, creates a risk that both the American people and the American economy cannot afford. Only after Capital One demonstrates it is the bank it says it will become should its acquisition be considered. Prior to approving Capital One's acquisition, that institution should demonstrate its commitment to the public by offering diverse product lines to diverse market segments. It should also have a strong fair lending record and a strong lending record in small business lending, not just small business credit cards. And it should be a known and respected partner in helping to promote strong communities. Capital One is not that bank today. I thank you for giving us the opportunity to speak today and look forward to any questions you might have.
Thank you. Should I make you like run around and sit in that seat?
That's what I suggested.
Would you like me to play musical chairs?
Yeah.
This is the testimony of Matthew Lee, the Executive Director of Inner City Press Fair Finance Watch. Good morning. Inner City Press Fair Finance Watch is opposed to Capital One's proposal to acquire ING Direct and to its related proposal to deploy ING Direct's deposits through the subprime credit card operations that HSBC acquired along with the notorious predatory lender Household International. You'll be hearing from other NCRC members about Capital One's disparate lending record and the systemic risk and lack of public benefit of the Capital One ING Direct proposal. Inner City Press wishes, therefore, to focus on what is improperly not before the Federal Reserve, militating for new application, new hearings, including in New York, and the dismissal of the ING Direct application as incomplete. First, as Inner City Press has argued in 9 written comments it has submitted to date, since Capital One proposes to pay ING partially in stock, ING should be applying to the Fed to acquire up to 9.8% of Capital One. That level of ownership, ICP contends, constitutes control for purposes of the Bank Holding Company Act. We've noted significant adverse issues in ING's record, including, for example, an active Department of Justice investigation of ING violating sanctions and doing business in Sudan and Syria. The Fed should suspend Capital One's incomplete application and require ING to apply. Various stock analysts have noted that Capital One's ING Direct proposal only makes sense, if at all, when combined with Capital One's proposal to acquire the Household International platform from HSBC. Reviewing only this non-subprime half of the related transaction is akin to segmentation in environmental law, often rejected by courts as arbitrary and capricious. The Fed should suspend Capital One's incomplete ING Direct application and require Capital One to describe into the records it released its related HSBC household subprime proposal. Particularly in light of Capital One's proposal to significantly grow in the subprime space, its September 20th announcement of the lending pledge may be a promise to engage in increased predatory lending. Inner City Press, based in the Bronx, where the large North Fork Bank franchise, which Capital One acquired and worsened, does business, has for weeks asked that a hearing be held in New York, one of Capital One's major markets. For some reason, this was not done. ICP is presenting this testimony through a fellow NCRC member in Chicago without prejudice to its ongoing demand for a hearing in Capital One's major market in New York. Capital One's mortgage lending disparities in 2010, the most recent year for which data is available, was more disparate in New York State than elsewhere. For example, in New York State in 2010, Capital One denied a whopping 72.7% of applications from Latinos and 69.2% of applications from African Americans, both higher than its nationwide numbers. Also in New York, Capital One is moving to eliminate 135 jobs in Mattituck, Long Island. In the District of Columbia in 2010, Capital One denied 32.4% of applications from African Americans versus only 11.7% of applications from whites, a denial rate disparity of 2.77. I'm going to skip some of this. It's in Matthew's written testimony. The Fed has yet to fully respond to Inner City Press's Freedom of Information Act requests and appeals. This should take place forthwith. Inner City Press has received a Federal Reserve letter of September 12th responding to Inner City Press's August 19th FOIA request by saying that there may be delays. In that case, the comment period should also be extended. In this context, it's unreasonable to expect responses to new FOIA requests, for example, for the withheld portions of the September 9th response that Capital One was supposed to send. The improperly withheld portion should be provided. And for the additional reasons previously mentioned, a public meeting should be held in New York. It's reported that although the Federal Reserve Board officials promised to unveil long-awaited key Dodd-Frank rules by the end of the summer, the central bank is likely to need additional time to do that. The rules which implement Section 165 of the Regulatory Reform Law cover some of the biggest issues in financial services, including risk-based capital requirements, leverage, resolution planning, and concentration limits. Given the issues raised, including by Federal Reserve official Thomas Hennig and NCRC and others about this proposal, it's imperative that the Fed either finalize these regulations before the public meetings or further extend the comment period. Thank you.
Thank you. Liz?
Good morning. My name is Liz Ryan Murray. I'm the Policy Director for National People's Action. The NPA network, with our co-founder Gail Sincata, were instrumental in the original passage of the Home Mortgage Disclosure Act and the Community Reinvestment Act. In the past nearly 40 years, NPA and our affiliates around the country have continued organizing in communities around issues of bank investment and accountability. Thank you for holding these hearings and for extending the comment period on the proposed acquisition of ING by Capital One. The stakes are high, and we are pleased to see the Federal Reserve taking seriously the issues at hand. The economic crisis that we are continuing to suffer through has at its roots the irresponsible and fraudulent behavior of the financial industry. In part, the lack of recovery to date is also a product of bank behavior. Too big to fail banks continue their risky trading of securities and derivatives, continue robo-signing mortgage documents, and even after a historic infusion of taxpayer dollars and near 0% borrowing, continue to sit on capital versus getting out affordable small business loans, affordable small dollar loans, and affordable mortgage loans. It's in this context that Capital One is asking to acquire ING, creating another too big to fail institution that is over-leveraged in one business line, heavily invested in the securities market, and critically under-invested in the well-being of mortgage and small business credit markets, particularly markets that need it most, low, moderate income, and communities of color. NPA asked the Federal Reserve to reject the application based on the increased exposure to systemic risk, the lack of community investment, and a demonstrable benefit to the public. As has been pointed out in comments and other testimony, Capital One is deeply leveraged in credit card lending. 75% of their business is credit cards. This concentration in a single business line is unparalleled in the industry and cannot help but make them more susceptible to market instability. If they're allowed to acquire ING, the dangers inherent in that obviously will grow, as will the risk not only to Capital One, but to the system. In addition, Capital One claims they are not involved in risky lines of business like the MBS or CDOs that brought us to the current economic woes. This is disingenuous. Capital One is a major securitizer of highly volatile credit card debt in asset-backed securities markets. As has been noted, Capital One's business is largely concentrated in credit card lending. In these trying economic times, the nation's largest and best capitalized financial institutions must be relied upon to extend a diverse product line of affordable and sustainable credit options to communities, especially to those communities at risk of wholesale disinvestment as the financial crisis enters its fourth year. Short-term and relatively high-cost credit options such as credit cards are no substitute for long-term, low-interest products. In recent years, the bank has reduced their small business lending through the SBA 7A loan program nationwide by over 99%, from issuing 5,000 SBA loans per year from 2004 to 2006 to 2 SBA loans in 2009 and 13 in 2010. This compares to an industry-wide decline of about 60%. Let me state the obvious. We are in an unemployment crisis. No institution that has choked off so completely their lending to the #1 job-creating engine in this country, small businesses, can claim to be serving the convenience and needs of the community. In terms of mortgage lending, the bank's home lending has declined by over 65%. The bank's refinance lending has declined by about 62% over this time period, significantly more than the national decline of 18%. Capital One and ING's lack of investment in low and moderate income neighborhoods is in stark contrast to Capital One's national reach in credit cards and auto lending, and ING's wide-reaching internet-based consumer deposits. This merger is a perfect example of how CRA has not kept up with modern banking business models. Assessment areas are very limited and based on the limited branch presence. Capital One got an outstanding rating, but it is impossible under the current exam and rating system for that score to mean anything. A hold on the acquisition should be put in place until such time as a true CRA exam and a score can be obtained, one that assesses their actual record in all the markets in which they do business. I began by laying out the challenges to our country and communities are facing due to a lack of affordable credit from the big banks. Our economy cannot recover without an infusion of capital and credit at the street level. It's clear that Capital One is not only no better than the pack, in many ways they're lagging behind an already faltering competition. The Federal Reserve should say no to this acquisition unless there is a diversification of Capital One's business, a true community reinvestment exam under modernized rules, and verifiable lending commitments that come with consequences for not meeting benchmarks. Finally, I'd like to restate again the urgent need for a modernization of the Community Reinvestment Act. Thank you.
Thank you. Mr. Palmer?
Hello, my name is Bob Palmer. I'm the Policy Director for Housing Action Illinois. Thank you for the opportunity to testify today. Housing Action Illinois is a public policy advocacy and technical assistance organization with over 150 organizational members. Many of our members are HUD-certified housing counseling agencies. My testimony is going to focus on two issues related to our concerns about Capital One acquiring ING Direct, mortgage servicing, and participation in FHA and other government guaranteed loan programs. The experience of HUD-certified housing counseling agencies in Illinois has been that bigger banks are generally worse for borrowers in the case of default. Some of the problems with big banks concern being unable to get accurate and timely information regarding what resources are available for borrowers in default and the status of loan modification applications, and that in addition to just the ability to get a modification at all. There are currently unresolved legal challenges related to Capital One's default servicing procedures. A recent suit filed by the National Community Reinvestment Coalition alleges that Capital One failed to respond to an application for a home affordable modification, HAMP loan modification from a borrower with a loan owned by Freddie Mac, which resulted in a denied modification request. According to the complaint, Capital One let the homeowner in question know in writing that it did not participate in HAMP, but also sent her a HAMP loan modification package. Yesterday, I myself received a package from the attorney for Capital One saying they do participate in HAMP for loans serviced by the GSEs. So this left me confused. We asked the Federal Reserve Board not to act on this application until Capital One can resolve these allegations and change its default servicing procedures to ensure a timely and accurate response to loan modification requests. The letter I got from Capital One yesterday also mentions its Capital One modification program. The letter states that COMP is similar to HAMP in its overall structure, but more widely available due to several underwriting criteria. We also asked that the Federal Reserve Board evaluate COMP in terms of the type of modifications offered and redefault rates. Finally, we asked that Capital One adopt and enforce best practices for mortgage servicing consistent with those recommended by the National Consumer Law Center in its May 12, 2011 testimony before the Senate Subcommittee on Housing, Transportation, and Community Development. In terms of FHA loans, in 2010, Capital One implemented a policy that cut off FHA loans to borrowers with credit scores between 580 and 620, even though FHA fully guarantees these loans. Capital One's policy would have a disparate impact in African American communities in the Chicago region, where 54% of individuals have credit scores of less than 620. Capital One has recently agreed to adhere to the FHA credit score requirements by 2012, but I remind you that the Federal Reserve is obligated to consider a bank's past activity to meet the convenience and needs of low wealth communities rather than base its decision on future commitments. The letter I got from Capital One yesterday also states that requiring them to offer FHA guaranteed loans to people with FICO scores between 580 and 620 would, quote unquote, qualify as subprime lending. From a bank's point of view, this means they will charge the borrower more money to cover what they say is their higher risk. Another definition of subprime lending is loans with higher interest rates and less favorable terms that make it more likely that a borrower will default, which obviously hurts the borrower, the bank, and the community. We recommend that Capital One commit to offer affordable and sustainable mortgage loan products for loan applicants with lower credit scores. We also recommend that Capital One actively participate in all government guaranteed loan programs, including the FHA, Veterans Administration, Rural Housing Service, and Small Business Administration programs. Thank you.
Thank you. Dory?
Good morning again. I'm Dory Rand, president of Woodstock Institute. Woodstock is a leading nonprofit research and advocacy organization focusing on fair lending, wealth creation, and financial systems reform. We work at the local and national level on behalf of low-wealth communities and communities of color to create a financial system in which everybody has the opportunity to borrow, save, and build wealth to create economic security and community prosperity. I want to thank you for the opportunity to testify today in opposition to the Capital One proposal to acquire ING Direct. We oppose this merger on the grounds that Capital One has an inadequate past record of serving the community needs, and on the grounds that the combined institution, as the 5th largest bank by deposits with a vulnerable portfolio heavily concentrated in credit cards, would pose significant systemic risk to the financial system. Finally, this application demonstrates the inadequacy of current regulatory systems for ensuring that large financial institutions with limited branch networks are meeting the lending and financial services needs of low-wealth communities. I know the Federal Reserve considers many factors in evaluating these kinds of applications. I'm going to focus on the failure to meet community needs. I was going to share 2 examples, but Bob gave one of them about Capital One's failure to make FHA loans to people with a 580 to 620 credit scores, even though fully guaranteed by FHA. I'd just like to point out that the bank's last-minute pledge to make those loans to qualified borrowers is not sufficient to demonstrate a past record of meeting community needs. Similarly, Capital One did not continue the community reinvestment commitments that were made by Chevy Chase Bank, which Capital One acquired in 2009. Under a settlement reached with the U.S. Department of Justice in 1994 for failure to offer services in communities of color, Chevy Chase had agreed to take all reasonable steps to obtain a market share of mortgage loans in predominantly African-American communities that is comparable to its market share in white communities. But according to an analysis by NCRC, Capital One has not achieved comparable market share in many of its markets, including the Washington, D.C. metro area. On the systemic risk issue, we believe that Capital One's heavy concentration in credit cards and the size of the combined institution will cause significant systemic risk. According to analysis by NCRC, Capital One derives 75% of its income from credit cards, a vulnerable income source during economic downturns when revolving credit lines shrink and charge-offs increase. No other bank in the top 5 relies on any one product for more than 32% of its income. Finally, Capital One and ING Direct currently have minimal CRA obligations as a result of their limited branch presence. Both banks carry out substantial portions of their business throughout the country, but have a minimal branch network. Capital One has credit card customers in Illinois, and ING Direct receives deposits from Illinois customers, but neither bank designates the Chicago region or Illinois as an assessment area. We urge the board to adopt meaningful modernization of the CRA rules, including changes to rules designating assessment areas, before considering approval of this or any application that would allow financial institutions to expand without clear community reinvestment obligations. I would mention that Sandy and Alicia's questions to Mr. Finneran earlier are right on point, and they need much better answers, including specificity on geography and enforceability of those last-minute commitments. If the Federal Reserve Board chooses to move forward with this application over our opposition and the opposition of our colleagues, we respectfully request that it grant only conditional approval and require Capital One to address these concerns. Specifically, we believe that the board should condition approval of the application on adoption of CRA assessment areas and reporting obligations where the combined financial institution will have a significant market presence. And there is precedent for doing this. For example, in 2003, the OCC required Charles Schwab Bank to have obligations and report on commitments beyond its CRA assessment area in a similar situation. The application of Capital One to acquire ING Direct proposes to create a similar financial institution with a national presence in both online deposits and credit cards, but minimal branch presence and CRA commitments. So it's appropriate to require CRA obligations with firm reporting requirements to the Fed. Thank you again.
Thank you very much.
Good morning. I'm Ted Wysocki, President and CEO of the Local Economic and Employment Development Council, Lead Council here in Chicago, and I am also the immediate past chairman of the National Community Reinvestment Coalition. I am testifying this morning in opposition to Capital One's proposed acquisition of ING Direct. I do not see sufficient public benefit of this acquisition that merits or deserves Federal Reserve approval. Lead Council is a nonprofit organization that for more than 29 years has promoted economic and workforce development here in Chicago. We help businesses grow, we train people for jobs, and we provide a link between business, the community, and government to improve our local economy. Capital One has done nothing here in Chicago and is proposing to do nothing to improve our local economy. As president and CEO of the Chicago Association of Neighborhood Development Organizations, I served in the late 1990s as a co-convener of the Federal Reserve Bank of Chicago's Small Enterprise Capital Access Partnership. Over a decade later, access to capital for small enterprises is not only worse, it is depressing. Capital One is not providing the access to the capital that is necessary to rebuild our local economies in these challenging times. Capital One has shrunk its lending to small businesses with revenues of less than $1 million. It has replaced traditional low-interest small business loans with high-priced small business credit cards. The small business community does not need gimmicks and reward points. It needs more loans with better lending terms. In 2009, Capital One N.A. did not make any non-credit card small business loans in low-income tracts in the Chicago metropolitan area. It only made a total of 92 non-credit card loans in our entire metro area. In contrast, all banks as a group issued 2.2% of their loans in low-income tracts here. In 2009, Capital One made only two non-credit card loans to Chicago's smallest businesses under $1 million in revenue. This was only 2% of all of Capital One's loans here. In contrast, all banks as a group issued 26% of their loans to these small Chicago businesses. Outside of the Chicago metro area, Capital One only made 9 small business loans in other parts of Illinois. When it comes to veterans, women, and minorities, they do not need apply. We're talking about capital none. SBA 7A lending is a lifeline for women, veterans, minorities, and low-income areas. Capital One's SBA 7A lending plummeted from $228 million nationwide in 2006 to an embarrassing $551,000 in 2010. I served on the Federal Reserve Board's Consumer Advisory Council from 1996 through 1998, serving as vice chair of the Bank Regulation Committee in 1998. I am appalled at the lack of true CRA enforcement when it comes to Capital One. Capital One has exploited regulatory loopholes to exclude its credit card lending from its last CRA exam by the Federal Reserve, shielding their main line of businesses from accountability to the public's needs and conveniences. In addition to inadequate geographical coverage, previous CRA exams cannot be relied upon to assess whether fair lending violations occurred or whether Capital One engaged in unfair, deceptive, or unsafe lending practices. The Federal Reserve's previous exam of Capital One's credit card bank astonishingly did not even assess the terms and conditions of their credit card lending, although serious questions had been raised. Why should the American public expect anything better from Capital One in the future? This litany of non-CRA enforcement and compliance provides no assurance that Capital One's belated $180 million promise for community lending is anything more than a numbers game that will go uncounted by its regulations. To plagiarize Capital One's latest commercials, we aspire to higher community benefits. In closing, I started my professional community development career 37 years ago here in Chicago, working for the mother of CRA, Gail Sincata. Her lifelong work was dedicated to getting the private sector to come into our neighborhoods and invest with us. I can assure you that Gail would be very clear what the Federal Reserve's next move should be. Block this bid. Thank you.
Thank you. I do have a question for the panel, and then I'll check with my colleagues to see if they have questions. So one of the things that, we heard last week at the hearing in Washington, and I anticipate will be likewise today, is that these hearings are very much kind of a tale of two cities. So we have panels that come up, such as yourselves, that have very strong feelings about the reasons to deny this application. And then probably what will follow is a panel of folks who feel very strongly that the bank has done a very good job in the same communities that you talk about. I know in Washington, we heard from housing groups, small businesses, others, all the kinds of products that you've mentioned today, where they've said that Capital One has been very helpful and done a very good job in terms of meeting the needs of their communities. I'm just wondering, how do we reconcile this? I mean, do you have any thoughts on that? Anybody? And I'm opening that to anybody on the panel. And I see Jim smiling, so I think he does.
Sure, Sandy, and I appreciate the question, because if you look at the agenda, it looks really powerful going in both directions. I think what we would say is look at the facts, not the opinions. So it's very easy for a community organization that received a modest grant of even as little as $25,000 to say this is a great partner. And for that organization, they probably are a phenomenal partner. $25,000 is not an insignificant amount of money for a nonprofit, even $50,000. But that doesn't in any way compensate for the systemic risk that is presented to the financial system of an institution that has a business model that is heading to failure. And in fact, many of the subprime mortgage institutions that literally were pursuing the most reckless, outrageous subprime mortgage practices were nevertheless supporting nonprofit organizations all across the country. But it didn't add up. So what I would say that the Federal Reserve Board really needs to do is look at the facts and the data and the statistics. And those are so overwhelmingly in the favor of this is not a good idea, that Capital One first must diversify its business lines. It must diversify its sources of income. It must serve communities in a way in which it can be measured in an aggregate way that makes sense, and that the benefits of the merger actually do step up to the table and compensate for the systemic risk that they present. And that is a very, very high bar to be presented. And I don't think that we've heard any institution present any data or any statistics that suggest that that test has been met. Thank you.
Anybody else want to, Ted or Dory?